From a small measure of market performance to the prestigious giant it is today, the S&P 500 has sparked countless success stories and sleepless nights. We'll explore its origins, trace its biggest movements, and uncover why so many see it as a cornerstone of the modern stock market, while still recognizing the risks that lurk beneath the surface. When Standard Statistics Company first toyed with the idea of an index in the early 1920s, few could imagine it would become a key benchmark of American capitalism. Back then, only a handful of stocks were tracked, offering a modest glimpse at market performance. But momentum was brewing. In the late 1920s, the seeds of a more comprehensive index were sown, reflecting a hunger for deeper insights into economic progress. Enthusiasm soared among investors who saw the potential of a more accurate gauge of corporate America. With each incremental advancement, they felt a surge of confidence, certain that with better tracking came smarter investments. Yet beneath the optimism was a lingering question. Could one measure truly reflect the vast and complex tapestry of the U.S. economy? In the 1950s, a transformative shift occurred. The index was expanded, rebranded, and ultimately named the Standard & Poor's 500, capturing a broader swath of the market. Now, instead of a narrow cross-section, a range of industries, from steelmakers to the emerging field of technology, formed part of the index. As trading floors buzzed with excitement, the index's unveiling felt like a grand reveal, suggesting a brand new era of data-driven investing was about to take hold. But as with all breakthroughs, curiosity lingered. How would this fresh yardstick hold up when real-world challenges hammered the market? Not long after the S&P 500 solidified its place, it encountered twists and turns that would test both the index and investor resolve. Economic booms, fueled by post-war industrial expansion, propelled stocks upward, creating a chorus of cheers from brokerage firms. Investors tasted the thrilling highs of a market, seemingly on a never-ending climb. Euphoria and confidence surged, seducing many to pour their capital into the new gold rush. Yet every upswing brims with potential pitfalls. When global political tensions rose, so did market volatility. The S&P 500 reflected these jitters in its data points, at times dropping so swiftly that even seasoned experts found themselves holding their breath. Steep declines served as harsh reminders that the market's upward trajectory was never guaranteed. Still, despite these jolts, the index continued to be revered for its ability to mirror the shifting tides of corporate America. So when the 1970s oil embargo roiled the global economy, the S&P 500 acted like a barometer, capturing the tumult and subsequent recovery. Observers realized how intricately this index was woven into the economic fabric, embodying hope, anxiety, and resilience all at once. Each major milestone, from expansions to recessions, etched a new chapter in the S&P 500's ever-evolving story, strengthening the idea that it was becoming a vessel for the economy's collective heartbeat. Some of the S&P 500's most memorable chapters revolve around its swift climbs and tumultuous plunges. Periods like the late 1990s dot-com frenzy, where technology stocks soared to once unthinkable heights, showcased the index's potential for dramatic growth. New millionaires emerged almost overnight, and the bubble of euphoria seemed endless, until it wasn't. Then came the early 2000s meltdown, revealing the market's darker side. Investors watched with disbelief as shares crashed under the weight of overblown valuations, leaving portfolios battered. The abrupt shifts were a stark reminder that what goes up can also come crashing down. A few years later, the 2008 financial crisis tested the index again, threatening to unravel the bedrock of trust in corporate earnings. This global event rattled entire economies, and the S&P 500 graph plummeted in a matter of months. Feelings of dread coursed through investors, turning confidence into panic. But as fear subsided, the market found its footing, rebounding slowly before surging to new peaks in the subsequent decade. Through these episodes, one trait persists: volatility. The S&P 500, as a measure of 500 leading companies, can reflect the best of times and the worst of times. Towering gains usher in celebrations, while unexpected drops can shake the most composed market veterans. Yet these swings are also what make it so alluring. Each new wave of volatility is an invitation for investors to reassess, adapt, and navigate ever-changing landscapes. Many see the S&P 500 as a fortress of stability. It's home to established corporate titans, some of which have endured decades of economic cycles. This prestige lures investors who believe they're getting a safer slice of the market. Funds that track the index have become near synonymous with a prudent, long-term approach. But even fortresses have cracks. While the index provides an expansive view of economic health, it can be deceptive. A handful of tech behemoths can grow so large that they overshadow all others, creating an imbalance in how the index moves. When these megacorporations soar, the entire index soars with them, sometimes clouding the fact that smaller constituents might be struggling below the surface. The flip side is that a major stumble by these juggernauts can pull the entire index downward, underscoring the hidden vulnerability in what is often labeled a safe investment. There's also a psychological component. People often assume the S&P 500's brand name alone insulates them from misfortune. The resilience it has shown during many past crises can instill a sense of complacency. But markets shift in ways that history doesn't always predict. Even robust, time-tested companies face evolving threats. Disruptive technologies, changing consumer tastes, and global events can rapidly transform the outlook for any sector. So while the S&P 500's storied past does reflect durability, it's not a bulletproof guarantee. Though widely regarded as a bedrock of investment portfolios, the S&P 500 isn't risk-free. Concentration in certain industries can build vulnerability over time, making the index susceptible if that leading sector faces unexpected headwinds. Meanwhile, global uncertainties, trade tensions, energy shocks, geopolitical conflicts can all converge to stress the U.S. market at lightning speed. On top of that, index investing can sometimes mask deeper financial issues. A surge in stock buybacks might inflate share prices temporarily, but doesn't necessarily reflect a company's underlying economic health. Heightened valuations can then leave the market precariously perched, exposed to sudden corrections. Furthermore, investor psychology often collides head-on with these fundamental truths. Enthusiasm can transform into greed when the index hits all-time highs, tempting people to enter at potentially overvalued levels. Conversely, panic selling during downturns can lock in losses. The irony is that the S&P 500 is often deemed less volatile compared to individual stocks, but in reality, it too can be quite unforgiving when the tides shift. That said, this index remains an enduring symbol of corporate America's triumphs, fueling countless retirements and fueling new wealth. The trick is to recognize it for what it truly is: an incredible tool for measuring market sentiment and growth, but not a foolproof shield. From a nascent idea in the 1920s to the modern-day investor's mainstay, the S&P 500 has enthralled generations. It's been a friend to those seeking a broad snapshot of the economy, yet it can become a formidable opponent during turbulent times. There's a kind of magic in watching it bounce back from adversity, reflecting the resilience and ingenuity of the corporations that power it. Still, that magic doesn't come without mystery. Even as we celebrate its storied past, we carry a healthy respect for the unpredictability that has shaped its journey and will continue to shape what lies ahead. Thanks so much for sticking with us through this look at the S&P 500. If you enjoyed the ride, tap that like button and subscribe for more deep dives into the ever-evolving world of finance. Your support keeps this channel going strong.